Are stocks headed for a catastrophic crash? Find out why experts warn of a 30 to 80% market drop and what the latest Federal Reserve actions could mean for your portfolio. Plus, discover the alarming truth about central bank digital currencies and their potential threats to financial freedom. Stay tuned as we break down these urgent financial topics from top analysts in just minutes.
Don't miss out. Your financial future could depend on it. Remember to like and subscribe for more time-saving financial updates.
First up, Michael Pento discusses the possibility of a massive 30 to 80% stock market crash. Next, Tavi Costa explains why recession indicators are stronger than ever. Then, Roth talks about the frightening potential of central bank digital currencies. Jeff Snyder reveals startling insights from the latest inflation report. Matt from Trade Brigade analyzes the SPY and QQQ market rotation. Joseph Wang breaks down recent economic events in his weekly update. Finally, Mike from Mott Capital discusses why this quarter's stock market earnings may disappoint. Welcome to the Thoughtful Money channel on YouTube. Today, we're taking a deep dive into the state of the financial markets.
That's right. Adam Taggart interviews Michael Pento, who's got some eyebrow-raising predictions about a potential 30 to 80% market crash. Buckle up.
So, what's the big takeaway from Michael Pento's argument today?
Michael warns that the stock market is running on fumes. He sees a serious risk of a crash because the stimulus money and liquidity that previously propped up the market are drying up.
All right, let's break it down. What's happening with economic indicators and conditions?
We had $6 trillion of stimulus and $4.5 trillion printed by the Fed, but that's drying up. Financial conditions have stopped easing, and credit spreads have stopped compressing. Liquidity is evaporating.
And how does this connect to the market? Is it as healthy as it looks?
Not at all. Michael says it's a facade. While the top 20% are fine, the bottom 80% is suffering due to inflation. The S&P 500 is actually being misrepresented by high-performing stocks like Nvidia, while the broader market tells a different story.
What about those negative real interest rates?
Michael points out that long periods of negative real interest rates between 2008 and 2022 led to asset bubbles in various markets. Now that real rates are positive, these bubbles are in danger of bursting.
Pretty sobering stuff. What are the policy risks here?
The Federal Reserve's policies have created significant distortions. If liquidity dries up further, we could face another financial crisis. If the Fed reverts to zero interest rates and quantitative easing, it might lead to stagflation, a nasty cocktail of stagnation and inflation.
Let's talk predictions. What does Michael see happening?
First, he predicts a market crash ranging from 30% to 80%. Second, he expects the Fed to be pressured into slashing interest rates again, which could reinflate inflationary pressures.
And what about long-term interest rates?
Despite Fed action on short-term rates, Michael thinks long-term rates could rise due to increased credit and inflation risks. Brace for a potential inversion.
Summing it all up, what should people take away from this?
Michael advises a strategic and cautious approach. Be proactive with your portfolio management. The goal isn't just to protect what you have, but also to capitalize on coming market turbulence.
Welcome to the David Lynn Show on YouTube. Today, we're diving into an episode with Tavi Costa, a portfolio manager at Crescat Capital. He's back with some bold insights on why recession indicators are stronger than ever and why it's time to rethink your investment strategy.
That's right. Tavi believes we're teetering on the edge of a financial storm, comparable to the 1929 peak. With his extensive experience at Crescat Capital, his insights are not to be missed.
So what's the main thesis of Tavi Costa's argument in this video?
Tavi Costa argues that we're seeing alarmingly strong recession indicators, drawing parallels to the 1929 market peak. He insists that it's crucial for investors to take these signs seriously as the economy is deteriorating rapidly.
All right, let's break down those key points. Starting with the recession signals, what did Costa highlight?
He pointed to the steepening yield curve, which historically signals an impending recession. He also mentioned the calm before the storm, where suppressed volatility often precedes major economic downturns.
Interesting. How about interest rates?
Costa projects that the Fed might have to cut rates drastically, predicting the 2-year yield could drop from 4.6% to around 2%. He coined the term T-bills and chill, suggesting the short-term treasury market is currently more appealing than equities.
Got it. And what about fiscal dominance?
Tavi warns that interest payments consuming nearly 4% of GDP will force the Fed's hand. He sees fiscal dominance as unsustainable, pushing the Fed towards financial repression to manage the debt.
What does he have to say about gold and commodities?
With central banks, especially China, aggressively buying gold, Tavi sees this as a hedge against economic instability. He advocates for investing in commodities and natural resources, predicting they will become a more significant part of portfolios soon.
And finally, his market predictions.
Costa believes equity markets are overvalued and due for a correction. In contrast, he sees short-term treasuries and commodities like gold and silver as better investment options in the near term.
Now for the crystal ball section. What are Tavi's predictions?
First up, he predicts drastic Fed rate cuts, potentially starting as early as September. He also expects the yield curve to steepen further, underscoring recession fears.
And what about the gold market?
He's bullish on gold, anticipating its price to rise as central banks continue to stockpile it. He sees it as a safe haven during economic instability.
All right, let's wrap this up. What are the big takeaways?
Tavi Costa concludes that we must brace for economic turbulence. He urges a shift away from overvalued equities towards real assets like short-term bonds and commodities. The goal is to navigate the impending financial storm safely.
Welcome to another episode on Kitco News. Today's hot topic is one that's sure to get your financial senses tingling. We're diving into the realm of central bank digital currencies, often abbreviated as CBDCs.
Absolutely. And to guide us through these murky financial waters is none other than Carol Roth, who's got some pretty alarming insights on what CBDCs mean for our financial freedom.
So what's Carol Roth's main beef with CBDCs?
Roth argues that CBDCs could spell the end of financial freedom. They'd give governments unprecedented control over personal finances, contrasting sharply with the decentralized nature of cryptocurrencies like Bitcoin.
Let's break down some of the key points Roth touches on. What's her take on government and Fed mismanagement?
She slams the government and the Fed for debasing the currency, which has driven people towards decentralized cryptocurrencies as a means of preserving wealth and securing financial freedom.
Interesting. And how does she compare CBDCs to cryptocurrencies?
Well, she points out that CBDCs are centralization incarnate. Where Bitcoin is decentralized, aiming to empower individuals, CBDCs would place immense control in the hands of the government.
Yikes. What about the potential for government abuse with CBDCs?
It's pretty Orwellian. CBDCs can be programmed to control spending habits, meaning the government could dictate where, how, or even if you can spend your money based on social or environmental policies.
That's a slippery slope. Any concerns about public understanding?
Roth is very concerned that the average person confuses decentralized cryptocurrencies with CBDCs, making them easy targets for government manipulation, especially when lured with promises of universal basic income or high exchange rates for digital dollars.
And she draws some parallels with what happened during COVID-19, right?
Exactly. The government overreach we witnessed during the pandemic, like cancel culture and economic restrictions, serves as a grim precedent for how CBDCs could be misused.
Let's get into predictions. What does Roth foresee about the future of CBDCs?
She predicts that despite current assurances, the U.S. will likely adopt CBDCs, driven by global trends and increasing governmental interest worldwide.
And how does she think this will impact personal freedom?
She believes it will devastate financial freedom, allowing the government to directly intervene in personal financial transactions and decisions, undermining the very foundation of personal agency.
Wrapping it up, what's the big takeaway from Carol Roth's insights?
Roth sounds the alarm on the severe threat CBDCs pose to financial freedom and wealth creation, urging the public to be aware and cautious. It's a call for vigilance against a potential seismic shift in our financial landscape.
Welcome to Eurodollar University on YouTube. Today's episode dives deep into the June CPI report, featuring the insightful analysis of Jeff Snyder. Hold on to your hats, folks. This one's a game changer for anyone keeping an eye on the economy.
Absolutely. Jeff's got a knack for unpacking complex economic data, and today he zooms in on some eye-popping anomalies in the core CPI. Time to decode those troubling signals.
All right. So what's the big takeaway from this episode? What's all the fuss about with the June CPI?
The core thesis. The June CPI report wasn't just disinflationary, it was disturbingly so. Jeff argues that the core CPI's drastic rate of change slowdown since March 2024 is a major red flag for economic health.
Let's break it down. What makes this CPI report so unique?
For starters, the core CPI saw an unusually sharp decline in its rate of change. This sort of downturn is exceedingly rare and indicative of significant underlying issues. It's like seeing a unicorn, but one you really don't want to encounter.
Comparing with history, any patterns or precedents we should note?
Jeff dives into past economic crises, like the 2008 financial meltdown and the 1980s recession, showing that similar sharp declines in the core CPI were red flags in those periods too. It's a clear sign that the economy's gears are grinding in an unhealthy way.
And consumer confidence, how does that factor in?
The University of Michigan's Consumer Confidence Survey backs this up. Confidence has plummeted over recent months. Consumers aren't just worried about inflation, they're anticipating worse times ahead, reflecting deeper fears about the economy and labor market.
So, what's on the horizon according to Jeff?
He warns that if this trend continues, we're staring down the barrel of a more severe economic downturn. It's not just a blip, it's a flashing red alert for potential broader issues.
To sum it all up, what's Jeff's final advice?
Jeff urges us to keep a close and wary eye on these indicators. The sharp drop in the core CPI rate can signal more than just a hiccup. It's a call to batten down the hatches and prepare for potentially rough economic seas ahead.
Welcome back, everyone. Today, we're diving into the latest video from the Trade Brigade, where Matt talks about some intriguing market movements.
Yes, absolutely. The video is titled SPY Made a New High, QQQ Did Not Market Rotation, and Matt goes into some key divergences and what they mean for potential trades.
So, what's the big takeaway from Matt's analysis?
The main thesis is that despite some volatility and a noticeable divergence between SPY hitting a new high and QQQ not, there's no major shift in trend. Instead, it opens up new trade opportunities.
Interesting. Let's get into those key points. What did Matt say about the overall market?
He pointed out that SPY made a new all-time high, creating a bullish outlook, but QQQ lagging behind suggests some potential short-term bearish setups. This divergence opens the door for strategic pullback trading opportunities.
Got it. How about SPY specifically?
On the SPY weekly chart, Matt highlighted strong buyer control and noted that even if there's a pullback, it's more likely to form a higher low. Key support levels to watch are $549.50 and deeper support at $540.20.
And what does he say about QQQ?
The QQQ didn't match SPY's high, forming an inverted hammer weekly pattern indicating a possible pullback. However, it's still holding higher highs and higher lows. Key levels to watch are $486.75 and $475.35.
Great insights. So any news on market internals?
Yes, Matt noted that market internals were strong on Thursday, but QQQ not making a new high on Friday adds to short-term bearish sentiment. It's crucial to monitor these levels before jumping into new positions.
All right, what's in the crystal ball for SPY and QQQ?
Matt predicts a mild pullback in SPY, forming a higher low and maintaining the uptrend. QQQ might see a more significant pullback, but should find support at the key levels mentioned.
And how about sector predictions?
Potential sector rotations could see tech outperform if QQQ holds its support. Healthcare and financials could also break out if they hold their ranges.
So wrapping it up, what's the final takeaway?
Matt's conclusion is clear. Stay cautious but strategic. Look for higher low pullback opportunities in SPY and QQQ as key support levels approach. Bullish momentum is expected to continue unless these critical support levels are broken.
Welcome back, everyone. You're tuned into Joseph Wang's YouTube channel. Ready for a week full of market dramas? Buckle up. It's time for Markets Weekly, July 13th, 2024.
Absolutely. Joseph dives into the roller coaster ride of recent inflation data, Japan flexing its currency muscles, and speculation about U.S. Treasury debt tactics. It's a financial thriller, folks.
So what's the main theme in this week's episode? What's the buzz in the market hive?
Joseph zeroes in on the impacts of softer-than-expected inflation data, Japan's strategic currency interventions, and the chatter surrounding the U.S. Treasury's debt issuance practices. These elements are shaking up the financial landscape big time.
Let's break down the action. What did Joseph share on the inflation front?
The CPI came in at a slight deflation of 0.1% month over month, with energy prices and rental inflation cooling things down. This led to expectations of a more dovish Fed, making the dollar weaker and gold prices sparkle.
And about Japan's currency intervention. What's the scoop there?
The Ministry of Finance in Japan executed a crafty move, diving in with an estimated $20 billion to bolster the yen. This well-timed intervention coincided with the CPI data, stirring up the equity markets.
Interesting. Now, what's the chatter about the U.S. Treasury's debt issuance shenanigans?
The juicy part. Some speculate the Treasury is boosting the stock market by favoring T-bills over longer-term debt. Joshua Frost dismissed this, detailing their regular and predictable issuance approach. He's got the inside track, but hey, he's on Team Biden, so color us a bit skeptical.
Time to pull out the crystal ball. What predictions did Joseph make?
First, the market is now eyeing possibly 2.5 Fed rate cuts this year, thanks to that soft inflation data. Secondly, Japan isn't done yet. Expect more strategic moves, including reallocating their massive government pension fund to back the yen without burning through foreign reserves.
Wrapping it up, what are the big takeaways?
Joseph urges us to stay sharp and flexible, keep an eye on the Fed's next moves, and monitor international currency plays. The market is nothing if not a grand chessboard of strategy and surprises.
Welcome back to Mott Capital's Market Chronicles. Today, we're tackling an intriguing topic. Stock market earnings may disappoint. Ready for some financial fireworks?
Absolutely. This video features our market maestro Mike as he dives into why this quarter's earnings might not be the fireworks show investors were hoping for. Let's break it down.
So what's the big idea behind Mike's analysis? What's the forecast for this quarter's earnings?
Mike argues that this quarter's earnings might not deliver the positive surprises we've seen in the past. He suggests that analysts might finally be wise to the game of underestimating earnings only to revise them upwards later.
Got it. Now, let's dig into the details. How have earnings estimates changed this quarter?
Interestingly, this quarter's earnings estimates haven't been downgraded as much as in previous quarters. In the past, estimates were slashed significantly before earnings season, then bumped up as companies reported better than expected results.
And what about revenue and margins? Are there any notable trends?
Yes, indeed. Revenue estimates for this quarter have been slightly adjusted upwards, a stark contrast to previous quarters. Meanwhile, margins have been adjusted downwards, setting a higher bar for earnings beats.
It sounds like future earnings predictions are also showing some caution. What's the story there?
Absolutely. Earnings estimates for 2024 and 2025 are slowly creeping lower, indicating a cautious outlook. Historical data shows margins starting high and then needing to come down, which aligns with these adjustments.
All right, crystal ball time. What are Mike's predictions for this earnings season?
First up, Mike predicts that we'll see smaller positive surprises this time around, given that earnings estimates haven't been slashed as much. He also forecasts that if 10-year Treasury rates fall, expected market returns could drop, potentially leading to lower stock prices despite a low-rate environment.
So, what's the final takeaway from Mike's analysis?
Mike emphasizes the need for investors to manage their expectations. This earnings season might bring fewer surprises and smaller beats than recent quarters. With future earnings predictions already sliding, it's time to face some financial reality, folks.
In this packed episode, Michael Pento warns of a 30 to 80% stock market crash due to drying liquidity and faulty Fed policies.
Tavi Costa highlights strong recession signals and suggests reallocating to real assets like gold. Carol Roth raises alarms about central bank digital currencies' threats to financial freedom, while Jeff Snyder points out the drastic slowdown in the core CPI as a red flag for the economy.
Matt from Trade Brigade and Joseph Wang also provide timely insights on market rotation and weekly economic events. Despite differing views, there's consensus on the high risks and need for strategic portfolio adjustments. Stay tuned for more in-depth financial analysis. Thanks for watching Financial Analysis in Review, for July 14th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.